Been 1 week since the FOMC, the Federal Reserve, met, and Jay Powell last week on Wednesday announced the Federal Reserve's decision to cut interest rates by 0.5%. This was one of the most talked about interest rates cuts that we've ever seen. And so, what has happened? Anybody take me up on the bet? Did mortgage rates come down? Um, well, let's find out and see how everything responded in the market. So let me share my screen. All right, so this is a picture of the 10-year Treasury bond, and as I mentioned last week, if you want to understand what's going to happen to mortgage rates, you've got to pay attention to the 10-year Treasury bond. And this chart right here represents the 10-year Treasury bond over the last month. And if we zoom in, we can highlight that September 16th was the date of the FOMC meeting. And look at this, we're trading around 4% on the 10-year Treasury. This was at a low for well over 12 months. You can, as you can see, as we're heading into the meeting, the 10-year Treasury is coming down from just an earlier high point of 4.27, just touching 4%. They speak at 2 o'clock, 2:30 is when they speak on Wednesday of last week. And what does it do? The 10-year Treasury begins to bounce higher, and it's continuing to march higher for the last week. We are now at 4.179. Here's where we are today, as of today. Unfortunately, this was what we predicted, and this movie is what we saw about 12 months ago. So let's go back to 12 months ago. And this chart here is the 10-year Treasury from just about 13 months of the 10-year Treasury. Let me try to zoom here, a little bit more than 13 months. But again, the same pattern was developing. This is August of 2024. Remember, August of 2024, the FOMC, their overnight bank lending rate was 1.25% higher than it is today. 10-year Treasury is trading around 4.2 again. And as we head towards the September meeting, it comes down, it comes down. In this case, it hit a low of 3.62 on the 10-year Treasury. And then they meet, their meeting, I believe, was the 17th and the 18th. And then, like clockwork, it begins to rise, and it rises, and it rises, and it's continued to rise while the Fed is cutting rates all through the final quarter of 2024. It rises, it rises, it touches nearly 5%. And so, as we know, because they're highly correlated, the 30-year fixed mortgage rate also rose. Unfortunately, this same movie played out and has played out over the last week. Um, This is a chart of the 30-year fixed rate. Now, this is going back 1 year, but as you can see, right, it's falling, it's falling, it's falling, and then on Thursday, September 18th, there's an inflection, and now it's rising. Thankfully, this is the national average of the 30-year fixed mortgage rates. Locally in the capital region, we have other options which can offer much more competitive rates. Um, Thankfully, Trustco is still holding strong at 5.99% on the 30-year fixed without any points. And if you put 10.5% down, there's no PMI. This is the most competitive rate right now that I've found on the 30-year fixed rate. If anybody has a more competitive rate, definitely share it. Broadview, you might remember last week we were looking at Broadview and their 30-year fixed rate was at 6%. It's now risen a full quarter in 1 week, despite the fact that the Federal Reserve cut rates by a quarter. So again, we need to reconcile the fact that the cuts in the rates at the Federal Reserve level may in fact lead to a different outcome in mortgage rates. And they may be correlated, they may be not. That's a separate discussion. But the point is that just because the Federal Reserve is cutting rates does not mean mortgage rates are going to come down. And I'll say it also does not mean that home prices and home affordability is going to get any cheaper. And I'll talk about that in a minute. The second thing I want to point out is that Broadview has an adjustable rate loan. And if you think we're at historic highs in mortgage rates, and if you think rates are going to come down over the next 5 or 7 years or 10 years, you might want to consider adjustable rate loan. Certainly, if you think rates are going to come down more than half a point or three-quarters of a point over the next 5 years, you might want to look at an adjustable rate loan. This is going to be fixed for 5 years and then adjust every 6 months after that. But you've got 5 years locked in at 5.25%, a full percentage point below the 30-year fixed. You've got 5 years to adjust as needed, if needed, or refinance. There will be refinance charges, but don't don't have anybody tell you that locking into a 30-year at this rate is a phenomenal strategy. I think considering most people will probably be refinancing in the next 5 years, even if you've got a 30-year fixed. Um, so what's happening with home prices? These are national numbers, and I'll jump to capital region numbers in a second. This just came out today, but again, home sales fell in August, partly to do with supply. Home prices slowed nationally, but they're still rising. Median home sale price is up 2% from a year ago. I'm also going to tell you that the numbers that we're seeing nationally are not move in the same direction, but often we have more significant moves here in the capital region. And what I mean by that is here in the capital region, if you look at the latest numbers, we're looking at August of 2025, you can see median sale prices for the capital region counties are up significantly more than 2% for the most part. In this case, Schenectady County, August of 2025 compared to August of 2024, 11.7%, nearly 12%, the home prices are up. And these are despite the fact that rates are higher now than they were in August of 2024. And we see this across 4 counties. Schenectady County, median sale prices up. Rensselaer County, median sale prices up 21%, nearly 22%, August of this year compared to August of last year. Saratoga, home prices are up 4.3%, 14.3%, August of this year compared to August of last year. Albany County saw home prices up 7.8%. This is in the face of declining mortgage rates, this is in the face of increasing mortgage rates. And so I want to reiterate that if home prices have risen year over year, home prices have risen year over year, while mortgage rates have also risen. And that what that means is that's become more expensive for a buyer who's financing a home. They've spent more on financing costs and they're willing to pay more money. If you accept that as the truth, which is the truth from the last 12 months, you need to appreciate that if rates come down, mortgage rates come down, home prices are only going to reaccelerate even faster. And so I get animated and excited about this topic because there's constantly a deluge of information from the front pages of the Wall Street Journal to the top of the CNBC NewsHour, where experts are purporting to tell you that we can make home affordability more realistic if the Federal Reserve just cuts rates. And unfortunately, that's not true. And I'll go a step further. I will say, unfortunately, as rates come down, mortgage rates come down, and eventually they will, as long as inflation stays tame. As rates come down, home prices will not. And if anything, home prices will continue to rise. And here in the capital region, where the median sale price is about 100,000 below the national average, and where we're surrounded by some high-priced home markets, we will continue to see, I think, a influx of people moving into the capital region from higher priced communities. And until we reach parity with the median sale price, which is still about 100,000 above where the capital region is, I think the capital region real estate market will continue to see price appreciation, and that price appreciation will continue to be greater than what we are seeing on the national numbers. So, for those that are in the market, whether you're buying, I appreciate it's a challenge and it's a slog, and be prepared for multiple offers. Be prepared to swing many times and miss. But with the right agent and the right tactics and the right approach, there's still possibility to find that home. And for sellers, I think this is a golden era for selling, and it's a big. The big reason why is there simply is just not enough inventory, and until the supply begins to catch up with the demand, um, we will have this structural deficit of lack of homes for sale in the capital region, and that will continue to be buoy prices and give sellers leverage. So hope that helps. We'll see where rates go over the next few weeks. I think over the long term, rates are going to continue to come down as long as inflation remains tame. And I think over the long term, that means the 10-year treasury is going to come down, and that will help or lead mortgage rates down. Um, but the big wild card is inflation. So hopefully that helps. Take care.